It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And Heidi Ho, it's the mayor, governor of the great state of Texas, Mr. Michael Becker. How are you, Michael?
Hey, Paul, doing pretty good. How's things going over in the Fort Worth side of town?
Well, we're doing good. As you know, Dallas is on one side of the equation. If you take a look at your right hand, that's where Dallas is at. Put your thumbs together. We're on the left side, left hand. DFW Airport is right in the middle. And so we have a different perspective. I'm on the Fort Worth side. Michael's on the Dallas side. And we bring everybody from Dallas, Fort Worth together. So we're uniters here, Michael. Uniters of the big divide.
Speaking of bringing everyone together, it sounds like we have the Old Capital Conference coming up here pretty soon.
September 14th and 15th of 2022. September 14th and 15th, 2022. If you are going to be a syndicator, if you're going to be an investor, if you're going to be a broker who sells properties in the Texas area, this is the conference that you want to be at. And so it is our annual conference. You know, last year we had it at Texas Rangers Ballpark in Arlington, Texas. We like that venue so much, we took the space next door, which is called Texas Live, which if you've ever been into Texas Live, it is a big cavernous area that has one of these huge big screen televisions. So we're going to take advantage of that big screen TV. So September 14th and 15th, 2022, we want you to go to the oldcapitalconference.com, oldcapitalconference.com. It's going to be another outstanding annual event. As you can remember, we've had Rob O'Neill, who shot and killed Osama bin Laden. We've had Roger Staubach, who, you know, the great quarterback and real estate guy for here in the Dallas-Fort Worth area. We have had Lou Holtz. We've had president of HEB talking a little bit about their attitude over at HEB grocery stores. I mean, he's responsible for 130,000 employees and leading the direction. So we have not announced who our guest speaker is this year, but we are going to do it shortly. So we'd love for you to be there. What's your feedback? Of course, you'll see Michael Becker there too, but Michael, what's your feedback of the annual conference?
Yeah, you know, I mean, you go to a lot of different conferences, Paul, and I think the one that you and James Zane put on are a bit more James than you, but I think it's great. I mean, it's different from the standpoint that these are actual people, you know, doing deals and doing transactions. So lots of sponsors, investors, and I think what's the most unique is actual brokers that sell multifamily deals. So you don't get to interact with them at most of these other conferences you kind of go to, short of maybe NMHC, which is a completely different deal. So if you guys are interested in doing multifamily in Texas, investing and or sponsoring deals, I think it's great. We'll give a bunch of data about kind of state of the market, but more than kind of the data that you hear or the presentations you see. It's really more about getting connected, pressing the flesh, and trying to establish or deepen some relationships with the players in town.
Yeah, the Old Capital Conference is one of the premier events. We've had it for the last 6, 7, 8 years or so. We have hundreds of people that come to it. It's a great networking opportunity if you're thinking about getting into multifamily and just to learn and be part of what's going on in multifamily. So as you know, Michael Becker, who is a former banker, so he was a loaner of money, and now he is an owner of real estate. So we love to get Michael's impression about what's going on in the current market these days. And so I'm going to go right to guns. Michael, are you seeing any green shoots coming out of this craziness over the beginning of summer, middle of summer? Are you starting to see some positive momentum building behind multifamily?
Yeah, we started the year out like gangbusters, kind of into 2021 and going into the first couple 3 months of 2022 were just absolute rocket ship, and all of a sudden someone threw the emergency brake up, and we didn't do a whole lot of transactions. Debt market, as we talked about here, and I'm sure anyone that's a participant in the marketplace has seen the debt market get really 180, very, very challenging, from being very easy to operate to very hard to navigate. And I'm starting to see some green shoots. We're a company, Paul. Last year we did 9 deals, 9 acquisitions, and this year we just bought our first one. It was actually an up leg of a 1031, sold a property in Dallas and bought another property kind of downtown Dallas. So pretty excited about that. I thought it was
tell us a little bit about how that one went, because I think that's gives you kind of a taste or a flavor about what's going on in the marketplace itself. What did you have to sell? And did you take proceeds from that sale to put it onto this? And how'd you find it and all those good things?
Yeah. So, the deal we sold was in kind of North Dallas, and we absolutely top ticked the deal. If you kind of use a stock analogy, we couldn't have waited 5 more minutes. I mean, it was just an absolute perfect execution from the sales side. Bought it in end of 19, put a floating rate mortgage on it. COVID hit right after we bought it, paid basically, SOFR, I think we're LIBOR on that one. LIBOR went to basically zero. And we, basically, I think we had a 195 spread. So we essentially played 2% interest only pretty much the entire time we owned it. And then we go to market January 4th, which we, saw a ton of activity at the end of 2021. And it looked like there was going to be very limited inventory. So we were, first deal out of the gates this year, basically just launched right out of the gate, picked a buyer, had a competitive bidding process, CBRE. The brokerage firm sold it to us. They brought it out and sold it for us, picked a great buyer. They were in exchange, executed great, got newer into town, but did a phenomenal job. And, got a great number. And then as we were looking to go buy something, then as they were closing, the market was kind of pulling back a little bit. Cap rates were expanding, pricing's coming in as the debt has, kind of eroded, as I alluded to just now. And then we got, I think, a superior located asset, equal to maybe a little bit better product, much bigger, another 70 or 75 units over the one we sold. And we paid about $20,000 a door less than what we sold the other deal for. So it was kind of like a win-win-win. And like I said, it was an up leg of a 1031 with a couple partners that we had into the deal, longtime investors of ours. So it worked out really well. And so I think that was a great kind of green shoot. It was really struggle to get the deal done at the onset. Trying to find debt in April and May was pretty challenging. And ultimately we got a Lifeco loan at, I think we were 210 spread over SOFR. So we took a floating rate Lifeco loan at 2.1% over SOFR. So I know, Paul, you kind of talk about, a lot of the debt funds that you guys have done. And I think got to put that perspective. A lot of the debt funds, which, are kept pulling back on their leverage. They were, 80, 75, 80% for the longest time. The spreads have gapped out to what, 4%, Paul, maybe 4.25 over SOFR. Is that today?
4.25, 4.5 right now.
And then what's leverage nowadays on that?
Yeah, just like you were correct. What it was at 80% one period of time long ago in a galaxy far away, and so now it's gone from 75. Now it's gone down to 70, and I'd probably say 65, somewhere in there or less on leverage on these deals, because you're talking about all-in interest rate that's going to be right around about 7% with say 4.25, 4.5 over SOFR these days. So that's what I'm seeing. A little bit of green shoots is that we're seeing Fannie Mae come back strong. And
I think that's kind of just illustrates the unfairness of this business, as we talk about a lot. I mean, we were able to get 58 levered on this deal and 210 spread. And if you go try to buy an 80s deal and you're less experienced, you're probably paying a 4, maybe 450 spread and get 65 levered with a debt fund, and you pay a ton in legal and all this other crap that comes along with these debt funds. So just kind of a good illustration of that, with the banks kind of being a little bit more choosy on who they're doing business with nowadays, as the environment got a little bit tougher. So it's just a little bit harder if you're trying to crack into the game right now with the lenders. But to Paul's point, I mean, that's green shoot number one for us. Green shoot number two is we actually just got awarded another deal. I won't say the name of it because we're still negotiating the contract, and we're trying to finish up our inspections and things like that. But in the Austin MSA, so it was a great deal. This was a deal that came out with probably 15% off the initial guidance. The initial guidance came out pretty high in April. They awarded it to a group in May at, maybe 7-8% off the initial guidance. And then that group couldn't actually perform. And then we're buying at 7-8% off of that awarded price to where we're going to get the contract. So probably, 15% off the top of the market. So I feel like it's a pretty good discount, and it's a brand new construction deal, kind of finishing lease up as we talk. It'll be pretty much stabilized by the time it close. But what we've been able to source, and to Paul's point, is we're going with a Fannie Mae near stable program. So Fannie Mae has a program, so does Freddie, that if the property's in lease up and it has, a clear path to be stabilized within 120 days of you rate locking, meaning 90% or greater within 120 days, is how they need to believe that it'll be there. they'll underwrite on kind of pro forma income and underwritten expenses. And then when you do an application, they actually take your fixed rate equivalent, which is what you size off of. And they set your kind of your sizing rate at application. So basically you have very little risk, which is the biggest risk in today's environment is, proceeds risk because your loan can, millions of dollars of loan proceeds evaporate overnight with changes in the market or changes in collections, which if anyone's been trying to do a deal here last, 4 or 5 months, kind of live that firsthand. This kind of eliminates a lot of that. So we're going to get a 65 lever loan. I think it's 215 spread is kind of what I think we anticipate getting. So, again, kind of an unfair business to be able to get 200 basis point spread inside of kind of what these debt funds are getting, have, proceeds certainty and a growing market and a great location and an asset with a pretty big discount to where they thought they were going to be. I mean, it's kind of check. So it's getting us to be bullish to actually go put some capital out at risk and bet that we can go out and raise a bunch of money. So that's essentially what is getting us a little bit more optimistic. So, a group that bought 9 deals last year, we're going to have our second one coming up in our first syndication. So we feel pretty optimistic and pretty bullish about it. But we're starting to kind of see maybe kind of the level, water's kind of finding its level a little bit, Paul, because, we're still looking at operations and rent trade outs and, you're kind of hearing about the market slowing, but I mean, we're maybe seeing a little bit of a pullback, but it's still talking about going from 17, 18% growth to 15% growth. So still dramatic rental rate increases pretty much across the board. So everything's really solid from an operational fundamental standpoint. It's just really, kind of getting the debt market to kind of calm down. And we're seeing the 10-year treasury peaked in May at, I think, 340. And as we record this, it was about 2.6%. So you're 80 basis points off of the peak, which is helping a lot of these, agency deals start sizing a little bit better with treasuries coming in, collections continuing to improve, pricing kind of coming down. You're starting to see, like I said, water kind of finding its level. And I think we're going to start seeing some more transactions. And I think anything we buy right now, we're going to be really damn happy we did here in about a year or two. This kind of pricing discount we're seeing.
You brought up an interesting point at the beginning of the conversation. You're talking a little bit about CBRE sold the property over in Dallas that gave you the ability to have the proceeds to buy the new one. Did you buy that property again from CBRE?
We did, yep.
And then talk a little bit about the etiquette. And some people who've never done multifamily before think that you should go out and bring it to the whole market to take a look at. And what has done you right? Or tell me a little bit about some of the etiquette that's in multifamily that some people need to know about.
Yeah, it's pretty customary if you buy a property from a broker that's kind of their deal to lose really when it comes time to sell it. So went out, got several opinions of value, but at the end of the day, we didn't have anything but a good relationship and good history with the same brokerage shop. So they're a competent firm and as big as almost anyone else in town. So it's kind of etiquette to go back with that same group. I mean, obviously, if you have some sort of personal relationship or some sort of strain in that relationship and you want to kind of pivot, that's one thing. But that's generally your etiquette is to go back with the same group. It's not always how it's done. Sometimes we had a deal that we sold in February that we bought from a broker, and then another broker brought us an off-market offer. So we ended up paying both brokers on the deal because the original broker didn't get it, but we still paid them a fee to try to make sure we kind of maintain the good graces of the marketplace, Paul.
What does that do for you though in the good graces? I mean, here's the broker that you didn't have sell the deal, but you paid them to a piece of the deal. I mean, why would you do that again?
Well, it's just kind of part of the way this world works. It's a relationship deal, and it's just kind of making sure you have a good reputation within the marketplace and have a bunch of goodwill. So for us, it was a relatively inexpensive way of making sure we maintain, goodwill, and that we didn't intentionally not go back with the same guy that ultimately sold us the asset several years prior, and we made a bunch of money on when we sold it. So it was a successful investment. So that's really kind of part of it, Paul. I mean, a lot of this stuff is, you make or break you on the margins in this business, So if you have nowadays, I mean, any buyer that can go perform, I mean, the brokers are taking serious because there's not much the same level of robust demand, say relative to say 6 or 9 months ago, where there's a ton of buyers out there and the broker really can, pick anybody they really wanted. Now they really need buyers and they're coming to us on a regular basis of following up with us. But at the same time, the market, the only thing I know is that everything's always going to change. So it's just continual flux, improving or declining, whichever part of the market that we're in. And making sure that you're on top of the market and having good relationships and getting access to the deal early or kind of getting that piece of information at the end, or having that broker go push for you if it's you versus another buyer and you guys have equal stature or whatever, that you need them to go to bat to you with the seller and push them your way over the other way. And that's kind of really what happened on that deal that we sold in Dallas earlier. We had 3, 4, 5 deals or groups just basically right there. This group was kind of new out of town, but one of the guys at CBRE used to work with one of the guys on the buyer's team, and he went out and vouched for him. And so we chose him largely on their word. So that relationship that the buyer had with the broker led them to get the deal over maybe a equally qualified group right next to him.
I know that we're going to have Danny Baker with CBRE, but the general sense of the market coming up here this next week or two. But just in the general sense of the market, what are you seeing for inventory coming out? I mean, very much, a lot of inventory coming out, or are you picking and selecting deals that you think, to buy that may be off market? Tell me a little bit about what you're seeing out there.
Yeah, I mean, as we had a bunch of inventory kind of that early spring that kind of went out to market. Some of the stuff closed and some of it didn't. So here we are, just beginning of August, kind of call it June, July, as that market was kind of imploding a little bit. You see a lot of deals kind of fall out. So the deals right now are kind of like your boomerang deals is what I'm calling them. That's the deal that we have in the Austin area. I mentioned that we'll be coming out with here right after Labor Day, actually, is when we're gonna launch it. And so that is a deal that was kind of a boomerang where, went out, got set, that group couldn't perform, came back at a lower price to us. And that's kind of the story I want to go tell my investor database, that I could go, hey, this isn't a deal that the buyer wanted some crazy number for. They didn't get it. We're buying it for less. This is a deal that the buyer wanted a crazy number for. They didn't get that number. They ordered somebody else. They couldn't perform. And here we are getting a documented discount to that price. I think that's a good story. And I think that's probably next handful of weeks. There might still be a couple of those deals left. But I think as we come out towards Labor Day, those deals are all going to be set or pulled. And then we're going to go back to, there'll be some more inventory coming out, I think, around Labor Day, but it's going to be very muted relative to kind of normal years, and certainly muted compared to last year. Because last year, the fourth quarter were just, gangbusters, probably record sales. So, there's very little inventory out there right now. This is a handful of deals. And I think, a couple of these deals are about to, like the one I'm buying in Austin, a handful here in Dallas are going to get set, going to kind of set the new level, I guess, of where pricing is going to be kind of from a cap rate perspective in particular. And then I think everyone's going to have a little bit more confidence in the marketplace that, okay, this is a new level. The debt's kind of stabilized a little bit. That's where the debt level is. So we can all make decisions going forward. So I think we'll see more inventory Labor Day, but it's not going to be like the prior years, Paul.
I think you did a great job, and I would bang the table on telling everybody that last month you did a conference call with a lot of your equity partners, and you talked a little bit about where the market is, how the property specifically, and you went through almost like the entire portfolio, and you had people that had invested in your transactions, and you gave them just a market update. I think that's great. And the reason being is that people have got to feel safe and secure to a certain extent. They've invested in apartments. I mean, they've seen the economy starting to pull back a little bit. They've seen their stock price of their portfolio of securities kind of pull back. They've seen interest rates go up. They've maybe seen slowing up in the economy. And so if you're not telling them about what's going on in the portfolio, because the fundamentals of the apartments right now are still fantastic, is they think that they may be down 10% or 15% or 20%, just like their stocks are. Tell us a little bit about your call with all, let's say your 1,500 or 2,000 investors, and how that went and how long that, what'd you talk about in that?
Yeah, we just went through some of the deals in the portfolio and just really kind of wanted to, everyone's seeing all the noise in the market and seeing if you watch CNBC or read the Wall Street Journal or whatever, you're seeing there's obviously some economic pain and the debt markets like we talked about on our podcast here, Paul. So I just wanted to kind of let everyone know, hey, this is what's going on. I mean, remind everybody because I live it every day. Do we have a floating rate loan? Do we have a fixed rate mortgage? If we have a floating rate loan, hey, our debt service is going up. So that's a use of money on a monthly basis. And then these rate caps, which are great that we have rate caps on most of the deals, but then the rate caps that we have on the deals are only, 2-3 years until they expire. Then you got to buy a replacement cap, and the lender's dramatically increasing the amount that you have to escrow 15 times. Some deals you're escrowing, $800, $1,000, and they're going to, 50, 60,000 or 40,000. I mean, just like crazy numbers. So anyways, it's just going up dramatically, the amount of monthly impounds with these, which are also using cash. I think the rates are kind of stabilizing and the market's anticipating a rate cut next year, pausing and then ultimately some rate cuts. So the forward SOFR curve is going to hopefully drop, which means the cap cost will hopefully drop by the time we actually have to buy the cap. In the meantime, the lender's impounding, dramatic 10, 15 times more on a monthly basis than what they were. So it's just a big use of funds that we have to deal with. So a lot of these deals, we had to go actually cut some of the distributions, which is not what we wanted to do, but it is what it is. I'd rather get ahead of it before we over distribute and kind of distribute all cash out and have some actual problems. So if your sponsors and deals that you're a passive investor, you're investing some deals with some sponsors and you have some adjustable rate mortgages, and your sponsors aren't doing similar analysis like I'm doing, then you're probably going to have a future problem that you may or may not have the funds to go fight it with. So we're going to have JP on the podcast here from Pittsford as well in the next week or so to kind of get a real-time take from him as well, kind of what's going on in the marketplace. But that's kind of what we're seeing. So, there's some headwinds, there's some tailwinds. I'm starting to kind of get a little bit more optimistic that we're starting to kind of find and maybe have found the bottom or close to finding the bottom, at least on the nicer, newer stuff that I participate in. I'm a little less confident in that statement. A lot of like the 70s and 80s vintage deals, because I think that those are the deals that are be a little bit harder, especially if some of these younger sponsors or less experienced sponsors that aren't as well capitalized, and they took 80-85% bridge loans, or maybe took a 75% bridge loan and layered 15% prep behind it and had a current on their common equity. And I've seen a lot of those packages kind of float around. Yeah, so we'll see how those perform.
Yeah, that 8% preferred return back to the limited partners. And if you can't pay that because you don't have enough cash flow on the property because you're holding the money back to pay for that interest rate cap, but you still owe the limited partners. I mean, I think you're just digging a hole in the backyard to have somebody put a bullet in the back of your head.
But I thought that a while ago, and the market kept going up and bailed them out. So, nothing's a certainty in this. So, but I think where the risk spectrum is, that those are the types of deals that are certainly more risky than buying a deal that's 60, 65 lever. That's, a nice deal and a nice market that's, doesn't have CapEx and et cetera. So I think the market will probably bifurcate a little bit. The cap rates will expand more on the lower end of the scale. They'll be a little stickier on the top of the grade, nicer, newer stuff. And that's what I've been thinking for a while. So I think we're kind of seeing that play out in real time. But I certainly made that call way too early. So, anyone that would have held properties from 16, 17, 18, 19, 20 in the workforce housing space certainly did pretty damn good. And the fundamentals on those are still pretty strong and for the most part. So it's not all just doom and gloom. I'm just saying that there's a level of risk within the spectrum of risk within these types of properties and locations and sponsors. And I think we'll start seeing that kind of get priced in the market where there was no real major differentiation on, workforce housing and Class A and the cap rate like it historically has been.
Go back when you're talking about, the fundamentals of ownership. If you currently own a property, talk a little bit about occupancy in your portfolio. What are you seeing out in other portfolios with other sponsors that you talk with? Rents going up? Are they starting to slow up? Give me some data out of your head about what you're seeing out there on the properties themselves.
Yeah, I mean rents are growing. I mean occupancy's high, or forward trends pretty high here. We're in August, so I think we're kind of wrapping up the best part of the leasing season right now. It's most of the leasing season is in the rearview mirror. So we're trying to come out of August as school starts in Texas, kind of mid to late August, generally speaking. So we're trying to come out of when people go back to school, summer travel's over. We're trying to be full. So generally speaking, we try to be 95% coming out of August, going to September. I think this year we're going to try to be closer to say 96, just to deal with some of the uncertainty out there. I'd rather be just a little bit more full than a little less full. So we're kind of seeing that kind of play out. I think our trend is such where we should be able to achieve that. Generally speaking, across the board, some deals will be a little fuller, some will be a little less full, but generally speaking, I think we're there. We're still seeing rental rate growth on both renewals and new leases, and so yeah, the fundamentals are real strong. I mean, I think we're in pretty damn good shape. We're starting to see a little bit of relief as well on some of the tax protests as well too. So that's kind of a welcome sign that we got banged up pretty bad here in Texas out of the gate. So to get that to be not as bad, I'm starting to see quite a bit of success. Travis County and Austin's probably the toughest of all the counties that we have, and we had one deal there that we had quite a bit of delinquency. We just couldn't get these people out. And so we're starting to see some movement on that, where a lot of these like real delinquent payers have been kind of fleshed out and their stuff got put on the curb last couple of weeks. So then I think that sends a message to all the other people that aren't quite as delinquent that your days are numbered. So we'll probably see some additional skips. They can go live somewhere else. And, I think that, 2.5 years out this pandemic, we need to go get our properties back. I read an article about how Los Angeles County further extended, I think, for another year, their eviction moratorium. So I can only imagine if you're a landlord in LA County and you had someone that hadn't paid you for 2.5 years and you got a whole nother year of that prospect. I mean, that's got to be pretty tough trying to make your bills, especially if you have like a 16 unit deal or something like that out in LA County, and a handful of people that game in the system. So that'd be pretty powerful. Pretty tough to deal with, and it's much more less of an issue here in places like Texas or Florida, Arizona, places like that.
What are you reading these days when it comes to apartment data? I mean, you guys have subscriptions to CoStar or Yardi Matrix or ALN, or
yes.
What stuff are you reading and interpreting these days? What do you think, say brand new folks that are coming into the business, if they don't have that stuff, how do they get that type of stuff?
Yeah, I mean, we have subscriptions, all that. So you just costs money to pay to play, basically. But yeah, read that stuff. I follow Greg Willett, formerly of RealPage, now with IPA. So he put some stuff out. His former colleague Jay Parsons, I find him pretty fascinating. So he's now the new chief economist at RealPage. So I follow him on Twitter and LinkedIn. So he's pretty frequent poster. The Real page has a lot of webinars they do on various topics, seemingly weekly. So I'll find those every month or so. I'll go check those out and kind of see what's just happened and watch those and try to stay on top of that. And then generally speaking, just read the business paper of the Dallas Morning News, the Dallas Business Journal, or same thing in San Antonio, Austin, kind of the markets that we play in. For example, this here recently, Wells Fargo just announced that they're expanding Las Colinas, which is, suburb of Dallas, east side of DFW Airport, putting a regional headquarters in that's going to host 4,000 jobs, something like that. So, there's a lot of good green shoots, and those are kind of consolidating a lot of other jobs in the big center. And there's a rumor that they've denied so far that maybe they'll be shifting the headquarters from San Francisco to maybe Dallas. So we'll see if that happens or doesn't happen. But, there's a lot of momentum. I think it's still happening. People are leaving the higher cost, tougher business environment locations to come to places like the Sun Belts. And that's a trend that's been going on a long time. I think it's going to continue. And, I saw that NMHC and NAA put out that over by 2035, I think we need over 4 million more housing units. I think it was like 120,000 in Austin, which is like the most on a percentage basis. I think it was like 260,000 more needed in DFW by 2035. So there's a lot of demand, and the fundamentals are strong. I think the environment's such that the fundamentals remain strong. So really, how do you navigate the capital markets And how does that impact pricing and cap rates along the way? Because I think the fundamentals are strong. And it's like I said, it's swirling, everything was just the wind was at your back for so long. Now you kind of got the swirling headwinds and tailwinds, and trying to make sense of all that is really, honestly, it's a little bit more interesting than it's been the last few years. Not always in the best feeling and the best way, but it's a little bit more interesting that you gotta kind of be a little bit more disciplined and kind of more of a stock pickers market. So the guys that can pick the right places, the right deal, and the right structure, I think you'll see bifurcated returns versus everyone just buy everything and everything goes up, which is kind of what we've been in the last 8 or 9 years. I think you got to be a little bit more strategic and savvy today than you have been in the recent past.
Mike is a good stock picker. So if people want to get more information about what SPI does, your company, how do they do it? And then what is SPI? I mean, what do you guys do?
Yeah, so I think the best way is just go to our website, which is www.spiadvisor.com. It's SPI like spy advisor.com. There's a contact form. You fill that out, get into the database, see future opportunities. Like I mentioned, we'll have one coming out around Labor Day. So if you're not in the database, make sure you want to see it, get in the database, and we'll get that out. That's one thing. And then two, we do a quarterly newsletter that'll be out towards the end of August, first week of September, something like that. So we'll do that quarterly, kind of by state of the market, and we'll have various articles and information about kind of what's going on in the marketplace. So you want to get that, just make sure you go to our website, fill the form out. And we just really try to focus on putting together high quality deals that we think are the best risk adjusted returns at that moment in time, Paul, and that we're really kind of focused on that. And we'll do a handful of deals, kind of advisory deals, what we call them, where we help high net worth individuals that generally are in 1031 exchanges that were kind of out of the area. You're coming from California and you want to come to Texas to buy a property and you don't know anyone in town. We'll kind of help them get home. We're actually finishing up an exchange right now for one of our clients. Sold a deal in Austin's, going to put him in a deal in Dallas that'll hopefully close in August. And he, made just $1 bajillion on the deal he sold. So it's going to be a pretty cool story. And, it's going to work out really well for him. So happy it worked out. But that's kind of really what we focus on. I think for the rest of this year, we're really trying to do more deals on our own, Paul, and just put some syndications out.
Yeah. So two things. One is that you got to get that newsletter, the quarterly newsletter comes out. What I really enjoy about it is Michael's partner, a guy named Sean. He's a mathematician. He's the guy that does the numbers and does the analysis about what's going on. And he writes kind of his column about what he's seeing out there on the apartment business, and he approaches it on the math piece. So make sure that you sign up for at least that newsletter, and you can get his perspective. He's a real sharp guy. He's a mathematician kind of guy. The second thing is, and people may not know this about this advisory business. You helped somebody a while ago, and I love this story, and we haven't told it in a little bit, about a gentleman that owned a fourplex out in California, and then he bought this and bought that, then bought that with the sales. Spend 2 minutes or a minute and a half telling us that story one more time.
Yeah, I had a fourplex, just happened to be Oceanfront, Marina Del Rey, sold it, about 100-unit deal.
And he was losing money on that deal, right? Or he was
it wasn't cash flow positive. Sold that and then turned it into a 188-unit brand new deal, and then sold that, turned it into a 280-unit deal. So, goes from 4 units to 280 units and now over about 5-6 years, something like that. And that deal's killing it. So we'll probably sell that and then go buy something even bigger, or maybe buy 2 deals at some point.
So he went from having a fourplex at Marina Del Rey, and he was like renting these units out, and he would continue to put money into the deal all the time. He wasn't making anything. He was flat on the deal, but it had a lot of equity in the deal, as you can imagine, was on the ocean. And he sold that. And did he exchange into a 100-unit building?
Yeah, to a 100-unit building, sold that, made 2.5, 2.6 multiple, whatever it was, and then turned that into a 188-unit deal. Turned that into 2 multiple, sold it, and then we bought a 280-unit deal in December with them. So that's on its way as we speak. So hopefully that'll turn into 350, 400 units one day, brand new construction somewhere. And then we might just kind of set that deal and stop doing this after. And once you hit the top of the food chain, we haven't quite hit all the way up there yet.
That is amazing. So he probably went from making just flat money to making.
Yeah, I don't know what it is a month. He makes
thousands of dollars a month.
I do know what it is, but tens of thousands of dollars a month. And he just, it's been a good outcome for sure.
Yeah, past performance is no indication of future returns, but I thought that was a fantastic story, and that's a real story. So the guys at SPI, Strategic Property Investment, those are the guys you got to talk to. So Michael, thanks for spending some time with us. Certainly enjoy getting your approach and your vibe about what's going on in the market itself. So thanks. And again, I'm Paul Peebles. Have a great day.